Good morning. My name is Ryan Nee. I'm First Vice President with Marcus & Millichap and the President of the South Florida chapter of NAIOP. I want to welcome everybody to the NAIOP South Florida 2021 Economic Outlook. I want to take a moment to acknowledge and thank all of our members, board members, and Gemstone sponsors. Because of your commitment to NAIOP, we persevered through 2020 and have a prosperous outlook as we enter 2021. I'd like to specifically thank our Diamond sponsor, BB&T, our Emerald sponsors, Duke Realty and Prologis, our Ruby sponsors, Butters Construction and Development, Centerpoint Properties, Colliers International, Marcus & Millichap, Tower Commercial Real Estate, and our Sapphire sponsors, Adler Realty, Ackerman, Berger Commercial Realty, Brody & Associates, Buchanan, Ingersoll & Rooney, CBRE, Simonelli Real Estate, Current Builders, Cushman & Wakefield, Excel Construction, Janae Property Group, GFA International, Graham Companies, Grover Corlew, Itasca Construction Associates, JLL, Miller Construction Company, Parkway, Risk Strategies Company, Styles, Sunbeam Properties and Development, and Workspace Property Trust. Thank you for your commitment to NAIOP and the commercial real estate community at large. Without further ado, I would like to introduce our esteemed panel. Mark Vittner is a managing director and senior economist at Wells Fargo, where he's responsible for tracking U.S. and regional economic trends. Mr. Vittner also writes for the company's monthly economic outlook report, and the weekly economic and financial commentary provides regular updates on the housing markets, commercial real estate, regional economies, consumer spending, and issues impacting small businesses. John Chang, Senior Vice President, National Director of Research Services with Marcus & Millichap Investment Services. Mr. Chang is responsible for the production of the firm's vast array of commercial real estate research publications, tools, and services. Under his leadership, Marcus & Millichap has become a leading source of market analysis, insight, and forecasting, and the firm's research is regularly quoted throughout the industry and in mainstream business media. Mr. Chang oversees a team of dedicated real estate research professionals who produce more than 1,000 annual market research publications and conference presentations across the entire spectrum of commercial real estate product types. The panel will be moderated by Darcy Lunsford, Senior Vice President of Butters Realty and Management and former President of the South Florida chapter of NAIOP. Mrs. Lunsford specializes in the representation of landlords in the leasing of office buildings in Palm Beach and Broward counties. Darcy and her team have a proven track record in the lease-up, reposition, and rebranding of office assets. Before I hand it over to Darcy, I just want to take a moment to remind you all to get your submissions in for the NAIOP Awards of Excellence. Enjoy the show.
Thank you, Ryan, so much. And so fancy, Mrs. Lunsford. It's Mrs. Lunsford to you. Good morning, real estate wheelers and dealers. I am Darcy Lunsford, Executive Vice President of Butters Realty and Management. And I'm the immediate past president of NAIOP Florida and the current chair of the NAIOP Florida PAC. Well, we're so glad to have you guys here today. And you know, it's still kind of weird and frankly, still surreal. This time last year, we were all gathered at our annual Power Breakfast Powwow at the beautiful new 550 building in downtown Fort Lauderdale, happily gripping and grinning about the promise of the new year. And ironically, it was that very morning that our first speaker, economist Mark Vittner, initially warned us about this emerging virus out of China. If it took hold, he said, it could throw a monkey wrench in the longest economic expansion cycle in our nation's history. Well, here we are. What a difference a year makes. I'm all gussied up on camera, welcoming you guys to NAIOP's virtual Economic Outlook event. And many of you are probably working from home today in stretchy pants. But we all possess that unwavering, stoic commercial real estate grit and near boundless optimism that 2021 is absolutely going to be better than 2020. There is always money to be made, right, guys? And as a wise real estate sage once told me, never let a good economic crisis go to waste. So NAIOP has gathered the top economists in the nation to tell us where the deals and dollars will be in 2021. We're going to start our program with Mark Vittner of Wells Fargo, who will illuminate us on the macroeconomic forces and trends that will dominate the 2021 business cycle. He will be followed by John Chang of Marcus & Millichap, who will drill down into what all this means for commercial real estate nationally and regionally. Now, I'm going to ask you guys to please keep your microphones on mute during the presentations, but after, we will have some time for Q&A. So use the ask question function anytime to type a question for either one of our economists. Okay, Mark Bittner, I'm going to turn the program over to you.
All right, I'm going to try to share my screen real quick and see that works. In terms of where we are right now, the economy hit another rough spot late last year as the COVID cases spiked again, and that was expected. I mean, we had been warning all year that between Thanksgiving and in February, that's the height of the flu season. That's when viruses tend to spread the most. So we were expecting to see the second wave. Then, of course, we had another wave in the summer, which came between then. And with that, we've seen that consumers have pulled back, and with that decline in employment that we got reported for December, I mean, it really made the second stimulus seem all that more important. I don't think the economy is backsliding, though. I think we are still growing. I think that fourth quarter GDP will easily be 4% or more, and first quarter will also see pretty solid growth, although we have a little bit more of a slowdown in Q1. The stimulus package that was passed is pretty substantial, and Biden has said that we're going to get more, and I feel like we probably will get more. I don't know whether or not the economy is going to need it. It really is being done to provide some downside protection. It seems to me that where we are in COVID right now is that the number of new cases probably peaked about a week ago, and it's always dangerous to try to pinpoint a peak a week ago. Deaths tend to lag new cases by about 2 weeks, so that would suggest that the number of deaths would peak next week. And the vaccine is ramped up. In the last 7 days, there's been an average of 900,000 vaccinations a day. And so if we can get up that, so we're almost to that 1 million a day that we need to be at to get to President Biden's goal of 100 million shots administered in the first 100 days. So there's a lot of things that are going right, and there's also the promise that we're going to get another vaccine approved by Johnson & Johnson at some point in the first quarter. So we've got a lot of things that are beginning to go our way. We have to deal with this slow period that's really hitting restaurants, travel, and leisure very, very hard, keeping people at home once again. And furthering that question of what's going to be the future of office space, because people aren't returning to office buildings. People are mostly working from home. The one area of the economy that's been very strong has been housing. And it's been strong because folks are working from home. They're educating their kids from home. And maybe their kids have come back from living in New York or some other high cost city where the benefits of that high cost aren't evident today because all the restaurants and bars and all the fun things that make New York worth living in aren't operating. So there's no sense being there. So all you have is a bunch of crime. And so you're like, what the heck? I don't need to be here. And people are leaving and coming back with their parents. That's been good news for South Florida. We've seen that home sales have been very strong. We've seen that condominium sales have been strong. On the supply side, supply has been very tight because folks that might have been downsizing because their kids have grown up are holding on to their homes. And so we're not seeing as many people put their homes on the market. And the net result of that has been a sharp increase in home prices. There's one other variable that's missing in there, and that is that there's foreclosure moratoriums and mortgage forbearance, which mean that we have fewer homes entering the foreclosure pipeline. And so there's really a dearth of sales at the lower end of the market, and that skews the home prices toward the upside. I'm going to go through the charts really quick. This is the latest trend in COVID cases. You can see that, there's hopes of a peak there. It looks like in all 4 regions of the country, it looks like we're headed down, and this data lags a couple of days. It actually looks a little bit better. Looks like the prior peaks. With COVID, there's always the hope. A year ago at this time, our main concern about COVID was supply chain risk. That was our main concern because we thought that, as with other things like SARS, that this was going to be contained to China or East Asia. And unfortunately, given the growth and the ties between China and the US, that's probably not going to be likely you want to prove not to be likely for this virus. It's probably not going to be likely for future viruses as well. One of the things that's come out of this whole disaster has been that we've got this flood of high frequency economic data. And one of the first was the open table restaurant data, which was really neat to watch it drop. But once it got down 100%, it can't drop anymore. But there's also things like the number of people who go through TSA checkpoints, the number of people who scan their security cards to get into office buildings. We have all of that data plus the mobility data from Apple and Google. The Federal Reserve Bank in Dallas collects all that data and puts it into a nice index, which is really handy. And that index has a very close relationship to GDP. And you can see that while there are a couple of wiggles in that line, it is still trending higher. The rate of improvement is slowing. That data is available freely from the Federal Reserve Bank of Dallas. It's also available on a regional basis as well. So you can get the data for Florida too. And the data for Florida shows a little bit stronger recovery. In terms of employment, we've regained about half of the jobs that were lost. We lost like 23 million jobs in March and April of last year. We've got 9.8 million jobs remaining. Most of those jobs, about not quite 2/3, but between 60% and 2/3, are in leisure and hospitality and other high contact areas of the economy. And that's things like fitness centers and in nail salons and hair salons, all that kind of stuff, repair shops. Construction, manufacturing, and logistics are all coming back very strong. Port traffic is up quite a bit. The tech sector seems to be doing very well, and that's evident in South Florida as well. Unemployment rates have come down. In Florida, it's 6.4%. It's very high in Orlando because Orlando is largely driven by tourism and conventions, and it's really struggling right now. It's a great time to go to Disney if you don't like a crowd, but it's probably just not as much fun. It's in the unemployment rates vary quite a bit around the state, and you get the areas that are not driven by tourism, and unemployment is almost back to where it was before the crisis. Another piece of the high frequency data that we get is daily consumer confidence data. In Florida, we used to get it twice a month. The chart on the left is the University of Michigan index. You can see how far it fell and how the relative recovery that we've seen since. On the chart on the right, it's just January of last year through early January of this year. And you can see that we've had a recovery, and then around mid-November, early to mid-November, we saw that activity pulled back, and that reflected how consumers pulled back. When you look at what's happened in retailing, that's been one of the hardest hit areas of the economy. Clothing sales are down the most because we don't need to buy a whole lot of clothes. I did get fully dressed today because I knew Darcy was going to be wearing all that bling, so I needed to look the part too and put my suspenders on. But spending is down virtually every category on a year-to-year basis. Restaurants are the next largest category. Travel and tourism down quite a bit. The one place that's up is recreation because people were buying bicycles and buying exercise equipment to exercise at their home. Also seen a little bit more spending on healthcare, and home improvement spending has been up considerably. People are spending more money on their homes. With folks traveling less, 2/3 of consumer spending is on services. We've seen that credit card use has come down. And you look at that trend in credit card debt, and then what's happened since the crisis. And most of that has been at upper income households. Lower income households, middle income and lower income households have not really paid down credit card debt that much at all. In terms of housing, as I mentioned, very low inventory in housing across the country. It's actually record lows in numbers of months and in actual physical inventory. The housing starts number we had this morning was a blowout number. We're right around 1.7 million units at an annual rate. So housing continues to go. The one big problem we have there is land costs are up, development costs are up, regulations are up, lumber is just through the roof, and that's, I mean, that is a pun, but and so just about every, that's all supply constraints. Not only that, the appliances are hard to get. With the increase in home prices, the amount of home equity that households have today is way beyond what it was at the height of the housing bubble. And I don't think that we're in a bubble today. Two things are happening here. One, a lot of folks refinanced to 15-year mortgages in the aftermath of the Great Recession. And so they were paying down much more principal. The other is that we've had tremendous home price appreciation and steady home price appreciation, then rapid home price appreciation in the last 2 years. The third is that banks have made it tougher for borrowers to pull money out of their homes. But when the spigot does turn back on and banks aggressively promote home equity loans again, there's a lot of firepower there. And I don't think that home prices are set for a fall because one of the big differences, we put a report out on this called 5 Questions About the Housing Market in late December. One of the big differences between the housing market today and where we were in the bubble years is there's a dearth of new supply. In the bubble years, you had all this speculative supply that was in the hands of people who took out 5 credit cards and bought 10 homes and hoped to flip them before the homes were completed, homes or condos were completed. And you had condo towers that expected in their pro formas to have 3 flips before they were completed of each unit. So, that's just not happening today. We're supply constrained. Looking at commercial properties, this is the commercial property price index. No real surprise here. Retail properties prices have fallen pretty hard. We've had a lot of bankruptcies. Prior to the pandemic, I had been saying that I thought that 75% of all the shopping malls in existence, and I'm talking about enclosed shopping malls, would be shut down by the end of the decade, and that would be by 2030. Now I think that number is closer, somewhere between 95 and 100%. Enclosed shopping malls they are a concept that peaked in the early 1970s, and that is a long time ago. I mean, that's and they've been in decline ever since. They've been in decline since the early 1970s. And so, when people realize that, they say, my goodness, and department stores peaked in the early 1960s. The median age of a department store shopper is 60. So, I mean, it is, that is not a concept for the future. And I'm not quite sure that any of the department stores will make it. I kind of feel like Nordstrom's pretty strong. Macy's is pretty big. Maybe they make it, but I'm not a fan of department stores. Haven't shopped in one in at least 10 years. So that's down the most. Industrial is held up the best. It's on the flip side of that. Office is down a little bit. I think people are too pessimistic on the office market, and apartments are holding their own. The uptown, downtown luxury lifestyle apartments have come under pressure, but the suburban apartments are doing very well. This is one of my favorite charts from a viewership standpoint. It shows the change in asking rents. The line at the bottom is San Francisco. You can also see that Miami was declining, but more recently, in recent months, Miami's rents have been rising as we've seen that migration to South Florida has increased. And I should say that Miami is Miami and Fort Lauderdale. It is not really Miami in this sense. But a lot of markets have been declining. On the plus side, Dallas, Fort Worth, Charlotte, and Raleigh, which have been some of the larger recipients of new residents from New York, along with South Florida, have been holding up relatively well. There are a few of the bright spots in the country, but San Francisco is in a situation right now where it's like, last one leave and turn out the lights. And one of the differences, and a lot of people think that people are fleeing San Francisco. The start of the story was they were fleeing San Francisco and New York because it didn't make any sense to pay these really high rents when you couldn't go to restaurants, you couldn't go to bars, you couldn't enjoy what you were paying to have proximity to. What's driving people out right now out of New York and San Francisco is public safety. People do not feel safe in New York and San Francisco. So in a sense, they're fleeing for their lives. And so, there's a huge move. In the case of California, I expect 1 to 3 million people to leave the state of California this year. So it's a big gap, I realize, but it's very hard to get numbers, and people that calculate population changes, whether it's the census or anybody else, they use different starting points, but it's going to be somewhere in that neighborhood. It's one of the most massive exoduses of California that we've ever seen. It'll be on par with what we saw in the aftermath of the tech bust. But the ironic thing is that the tech sector is booming today. And it's just that the tech workers are choosing to work remotely. In terms of inflation, big question here. I'm going to wrap up in just a minute. The Fed wants to get inflation back above 2%. I think they're going to be very successful. I think inflation is probably going to be running between 2.5% and 3%, if we're lucky. If not, it may be running between 4 and 5%. The Fed's creating an awful lot of money. I don't want to go through a whole course on economics here, but if you're running a budget deficit, you have to have somebody to buy those treasury bonds. You have to issue debt. And if there's nobody to buy it, if the Chinese say, hey, we've got plenty, which is what they're saying, we got plenty, then you have to sell those bonds to the Federal Reserve. And the Federal Reserve just, they just make that money out of thin air. All they do is they go over to the computer, they click it, they debit the account of Goldman Sachs and say, yep, you own those bonds, we'll buy those bonds from you. And so that's new money creation. The money supply has increased more in the last year than at any time that we've ever seen in modern US history, way eclipsing anything that happened in the 1970s when we had that horrendous inflation at the tail end of that. So, I remember when Arthur Burns, reading through the transcripts, I was too young to do it, but I read through the transcripts, and he told Nixon he was very upset about OPEC raising the price of oil. He says, you know what, we're just going to inflate them out of. I think he said inflate the bastards was his word. Him and Nixon, they didn't mince words, and but that's what they did. They just increased the money supply and created a tremendous inflation. I'm a little worried about inflation. I'm not tremendously worried about it, but I am a little worried about it. That's one of the reasons that we've begun to see the bond market get a little bit of life to it. And the 10 years gotten up to about 1.1%. We're not going to wake up and have high inflation at the end of this year, but the 10-year will probably get to 1.5 by the end of this year. It'll be between 1.5 and 2 at the end of 2022. That's all I've got here. I've got a couple of charts on Florida and South Florida, just to show you real quick. We lost 1.2 million jobs in Florida. We have 483,000 jobs that are still missing in Florida. All this data is going to be available for you. This is the mobility index. You can see how things bounce back in second half of April and May, and then it kind of been flattish. We haven't seen a whole lot of improvement over the summer. We continued to grow. You look at employment, we still got a long way to go to get back to where we were. Most of those job losses are in leisure and hospitality, but leisure and hospitality is more important to Florida than it is to the country. It's very important. The two most important parts of the state are in Central Florida and South Florida. And in South Florida, it has a very strong carryover into retail trade as well, which has also been off. We've got our forecast for Florida here at the tail end. This is about 2 weeks old, and we're forecasting 4.7% growth in Florida. U.S. growth, we're forecasting at 4.8. So we're looking for Florida to basically match U.S. growth. And one of the reasons for that is that we expect that travel and tourism is going to be slower to recover than the overall economy. So let me stop there, and I think I'm going to turn it back to Jules.
Thanks, Mark. You got me. A wealth of information as always. And now we're going to turn it over to John Chang of Marcus & Millichap to kind of drill down on what this means for commercial real estate.
Thank you so much. John, do you have slides coming up for me? I want to make sure we get those. And while you're pulling up the slides, I'll go ahead and get the ball rolling. When you look at all the wonderful information that Mark just shared, and all of the insights that he brought to the table, I think we have this mixed picture. If you could step to the next slide, we have a mixed picture of where we think things are going, and you can bring up the animation. We have record COVID cases, and that is a very serious issue. It's a health issue. It is also restraining our economy. We've had this choppy recovery, but the bright news, the bright spot is we do have the vaccine rollout in process. So we have this light at the end of the tunnel, and getting from here to there is, may take somewhere around, 6 to 9 months. And so while we're going through that, we're relying on a lot of this stimulus that we've already seen. 2.2 trillion came out last year in March. Another 900 billion that came out in December. Biden is proposing another 1.9 trillion that will come out, and that will probably be negotiated down, but will provide more resources, probably into unemployment support, stimulus checks. And really, all of that is just to build a bridge to the other side. Once we clear through, once we hit a critical mass of the vaccine rollout, then the economy can start to recover. We get restaurants and bars back open. We get shopping back open. We get entertainment venues back open. And the economy is going to catch and start to recover very quickly. I agree with Mark that there is some inflation risk out there, but right now the Fed is kicking that can down the road and saying, hey, I'm not worried. Inflation's low today. We're not worried about inflation tomorrow. We're going to use an averaging model to balance that. Yes, it could get away from us a little bit, but the good news for real estate investors is that real estate investments tend to be inflation resistant. Because they have built-in rate increases associated with it, or they mark to market very quickly. So there is some inflation risk out there, but we are still in the process of recovering from a job standpoint. South Florida is still 175,000 jobs below where they were a year ago, and that's going to take time. We have to get the service sector reopened before we can really recover all of those jobs. We have to get the hotels back open and the restaurants and so on. So those are the short-term headwinds. But once we get to that next point, we will see a release of pent-up demand. One of the things I'm focusing on is that we have a large volume of savings that have accumulated over the cycle. It is far beyond what we've seen historically, about $2.5 trillion of additional savings beyond normal. In addition, there's another $2 trillion in excess money in money market mutual funds. And that's money that is sitting on the sidelines and waiting to come back into play. So once we get to the other side, once we get to a point where we have a critical mass of vaccinations, that pent-up demand comes back into play, and we see a huge spark in the economy that's driven there. Now, there have been many changes of lifestyle as a byproduct of the pandemic, and Mark alluded to several of them. We talked about San Francisco, we talked about New York, but we have migration patterns that have changed. Actually, they didn't so much change as they were accelerated. We have work from home that has unlocked a lot more living flexibility, and that's spurring a lot more migration. We have a lot of people going south in general. But, you know, from a commercial real estate standpoint, our overall investment thesis holds. We believe that commercial real estate will continue to be a fantastic investment vehicle. In fact, we see it strengthening over the course of the next year and beyond. But investors are going to have to adapt. They're going to have to recalibrate their portfolios, their strategies, based on where we are today as a starting point and where they want to be in the future. The pandemic has opened a lot of new opportunities, right? So people are waiting for distress, and in my opinion, there won't be very much distress. There'll be a very limited amount, predominantly in the hotel and retail sector. And with the retail, a lot of that is going to be centered on adaptive reuse. There are opportunities to play a recovery market like a New York or a San Francisco. And there's also opportunities to invest on a momentum strategy that we see in Florida. So ultimately, we see a very strong prospect for commercial real estate once we get through the short term, and that's going to be the key. And next slide, please. And we can actually step past this. I want to talk a little bit about migration. And what we have here is 2020 leading states for migration. You can see the Pacific Northwest, the state of Washington, Texas has long been a leader in the migration trends. We see Virginia, North Carolina, and Florida rounding out the top 5. Florida has predominantly been at the top of the migration trends over the last several years. We have a lot of people moving from the Northeast and the upper Midwest down into Florida, and that's spurring demand and growth in the real estate sector. We're also seeing it going into Tennessee, Georgia, Arizona, Nevada, and a few other states seeing some pretty good migration trends. On the next slide, we have some of the population growth specifically for South Florida and household formation for that market. And you can see that it's well above the population growth and the household formation of the United States. We have a little bit of bounciness and there's rises and dips in here, but we expect this to continue to strengthen. We expect it to continue to gather momentum as more people are unleashed from the offices in New York and other major metropolitan areas and allowed to work from home more frequently. And we expect that for lifestyle reasons, Florida becomes a stronger destination for many people working from home. Now, companies, and I'll talk a little bit more about this in the office section, but companies are adapting to this model. So whereas, 10 years ago, a company said, here's our office, and if you want to work for us, you need to move here to our headquarters. They moved the people to the job. Today, they're adapting, and this actually started when the unemployment rate was down at 3.5%, a year, 2 years ago. They started adapting to moving jobs to the employee base. Most notably, we saw this with Amazon when they were taking, exploring the option of HQ2. And one of their key reasons was they've tapped out the talent in the Seattle metropolitan area, and they're looking for a new home, a new market where they can expand and grow, where there is a talent pool. Now that people are moving to different markets, other companies are adopting that model on a bigger or smaller scale. We saw Goldman Sachs moving one of their teams down into Florida and so on. And I expect that that's going to continue. Next slide. Florida is also the beneficiary of the relocations in terms of income and the movement of money and jobs. So this is 2018 data, but from what we can tell, it's actually accelerating in favor of Florida, but people are moving to Florida. The income of the people who are moving there tabulates to $32 billion back in 2018. People moving out of Florida tabulated to about 16 billion. So Florida was the #1 state in terms of inflow of income, the income of the people moving in versus those moving out. So it's a winning mix for the Florida area. We're going to move into the next set of slides now. We're going to talk about the commercial real estate more specifically. And on the next slide, we have the office market. Now, there's a lot going on this slide. You will all have access to these later if you'd like. But basically, the blue bars are completions as a percentage of inventory. The orange bars are absorption as a percentage of inventory. And then I have a little table showing the supply overhang, comparing the financial crisis to the health crisis. The very good news, of course, is that in terms of the supply overhang, the health crisis is, generally speaking, about half the level of what we saw during the financial crisis. And there's a lot of reasons for that. We don't have the liquidity lockup. We don't have the severe overhang of development that we were experiencing last cycle. In fact, development has been very, very controlled and almost muted over the last few years. But we did see a very sharp decline in office absorption. And that reflects the fact that we had a pandemic. People were working from home. Companies were not going out and leasing additional space. They don't know what's on the backside of this. They've been waiting to see, and the pace of absorption has declined dramatically. The good news for office investors is that once we get to the other side of this, once we have a critical mass of vaccinations, a lot of that leasing activity will recover. The big variable in between is whether or not companies are going to need as much space as they did before. They may have more employees working from home and less coming into the office. Therefore, theoretically, they need less square footage. The flip side of that is that they may allocate a larger square footage per employee in the space that they do get. The other piece of it is that we're seeing a lot more of that demand shifting from the urban core out into the suburbs. And although actually Florida is one of those markets which has a very high, a much higher concentration of demand in suburban areas relative to, say, a market like New York or San Francisco, we still see that trend playing out. In the next slide, we're going to focus on industrial and what's happening there. It's a little different than what we're seeing in the office section. Next slide, please. What we're seeing in industrial is we have actually construction ramping up. So office, we saw construction coming down. Industrial is going up. We still see that taper in demand and absorption. Again, companies have been more reluctant to go out and add to their space over the course of the pandemic than they were in years past. On a broader national scale, especially in port markets and intermodal hub markets like Atlanta, Dallas, Houston, Chicago, New Jersey, you have a lot more demand driven by e-commerce and safety stock for grocery stores and other businesses. And you see that more actively than we do in South Florida, where a lot more of the warehouse space and the industrial space is to service the local market. So we do again have a soft patch, which will drive up our vacancy rates in South Florida because of that slower absorption. But again, this is a short-term trend. Once we get to a more aggressive pace of economic growth, we can see that momentum continue to pick up. And again, the supply overhang is roughly a third of what we saw during the financial crisis. So a lot better outlook there. In the next slide, we have what's going on in the retail side. And again, the good news here is if you look at the construction and the completions of retail space, it's very, very low. I mean, we don't have anything like what we were looking at in 06, 07, 08, where that blue bar is stretching to the roof. We have a much more muted level of construction. The absorption has been negative so far in 2020. And this is through third quarter. We expect it to become even more negative. We expect to see more churn on space in 2021. The reason is we have a lot of businesses going dark. We have lost a lot of companies, but that space has not come back onto the market yet. So technically, it is not yet quote unquote vacant space. So we haven't seen a surge of vacancies rise yet. As that space comes back onto the market, we will see vacancies continue to move upward. And you can see on this next slide, we have our vacancy rates by different property types. Apartments included here have generally been stable, but we do see upward pressure on vacancy rates in apartments for reasons I'll mention in just a minute. Office, we see that uptick as well. A lot of that is going to be driven by downtown space, much more so than the suburban space, which is actually getting a new look and some fresh demand coming in there. Retail, as I mentioned earlier, we have that vacancy rate creeping up to about 5% in South Florida. We will see that continue to rise as the companies that go dark actually vacate space and it comes back onto the market. And industrial, with a vacancy rate of 6%, I expect that to continue to rise through 2020 as completions outpace the recovery in absorption. But as we go into 2022, I expect that will reverse again. So in the next slide, Here's our rents where we've seen them over the last few years. Again, apartments and retail both seen downward pressure on rents, but not nearly as bad as what we saw during the financial crisis, with the prospect of a bounce back. And again, I think each of these has a story to tell. Apartments is much more about an influx of construction coming online relative to people's ability to move around, and hence a little bit of softening in the upper tier, new construction space. Retail is softening, but this is very targeted, very specific. This is shopping malls. These are older centers. If you're looking at grocery anchored suburban shopping neighborhood and community centers, I think that there's a lot more strength in the underlying rental demand. Office, even though we've seen some softening in office, we're seeing a little bit of a rise in rents. One of the factors driving that is that a lot of tenants are extending existing leases on a short-term basis and paying a premium for that space. So this is not a number. I wouldn't expect this to hold over the longer term. Once we get again to the other side, we start to see that absorption recover. We see the leasing activity revive and people move out of a holding pattern. We can expect that to actually normalize. So, and then finally with industrial, we see a little bit of upward pressure, 2.5%. We expect that to be sustained going forward. Next slide. When we look at the apartment vacancy, this gets back into my argument of the downtown versus the suburbs. Now, as I mentioned, South Florida office tends to favor the suburban markets. That's not the case in other major metros, but we are seeing a lot more strength in suburbs and a lot less momentum in downtown. Part of that's lifestyle, part of that's the amenities, part of that is tied to what's happening with people relocating out of the urban core and into the suburbs, part of its demographics and the aging of population. We expect this trend to continue and move forward into the recovery cycle. Next slide. When we look at the vacancy rates for apartments, I mentioned we're really seeing it at the top end. It's a Class A problem. So your Class C vacancy rates, 2.5%, those are stable. The demand for that housing, that workforce housing, remains strong, actually, and it will strengthen even more once we come out of the other side. And nobody's building anything new in that class. The Class B is stable, 4.5% vacancy. We expect to see that come down in the latter part of this year as more household formation is unlocked. Your challenge area is your Class A product, where we've seen record levels of construction coming into the market at the same time as we have this recession and more people moving into single family homes. So there's going to be more challenges there. The overall vacancy rate will rise, driven by that Class A space. You're seeing that weakening of rents in the Class A space, more concessions. Your B and C product will continue to see rising rents and continued rent growth. I've tossed in hotel occupancy numbers here as well. Basically, Florida it has come down. It's down. Occupancy is in the 49% range instead of the low 70% range. Once travel starts to unlock, we can see a very quick recovery in hotels. It's not going to be a snapback, but we're going to see some momentum. We see these numbers pushing up for Florida into the 60% range relatively quickly as people start to go out and stay at hotels again. Wrapping up, we're going to some investment sales trends. What we've seen in terms of sales activity is it's down overall. Nationally, it's down in Florida. Apartments down 42%, retail 26%, 18% for office, and 32% for industrial. We expect that the sales activity will make a recovery through 2021. We're already seeing momentum recover in the third quarter data that's the far right here. Fourth quarter appears to have been a little bit stronger, and we expect momentum to continue to revive. Next slide. When we look at prices, they've been relatively stable we haven't seen that much pressure on them. Apartments continue to see upward pressure on pricing. Office rising also. I think that's going to flatten out a little bit. Retail is going to soften. I do expect it to flatten. We may lose a little bit of ground on the average retail prices overall, but it's going to vary by type of center, with the suburban centers holding up better if they have good anchors compared to shopping malls, which are going to get very soft and see a lot more adaptive reuse. Industrial has already flattened out. I expect it to hang out there as we move forward into 2021 before starting to make some momentum. Next slide. One of the key factors is the exceptionally low cost of capital today. That is supporting the yield arbitrage and the yield spread that gives the positive leverage to support investors' returns. You can borrow money on apartments in the upper 2% range. Other property types, office, industrial, you may be in the low 3% range, and other properties go up from there. Retail is a little bit harder to finance, and hotel harder still. But the point is that that yield spread has widened out to an exceptional level, offering investors a lot of opportunity. And as I mentioned earlier, there is a lot of liquidity and a lot of capital waiting to come back into the market. In the next slide, I can just point out that Marcus & Millichap has helped investors bring almost $9 billion of capital into Florida over the last 5 years. Again, we see the liquidity and the mobility of capital becoming more aggressive and focusing in on states like Florida, Georgia, North Carolina, Texas, Arizona. All of these markets where we see in-migration are going to be the beneficiaries of liquidity. By the same token, you see money coming out of New York, out of California, aligning with that migration. And for my final slide, as we wrap up, we have so many factors aligning for Florida. Population migration from other states. Florida ranks #1 in 2019. When we see the gain in population, it ranks #2 nationally overall in gains in population since 2007, #3 nationally among the states for job creation since 2007, #5 in the country for economic growth. The prices tend to be lower than most gateway and major coastal markets, and the cap rates are higher than you see in most other markets. This is an attractive investment channel for investors, which is driving that capital. It's pulling money out of other states and attracting it to Florida, which will boost overall demand and activity over the course of the next year, once people feel comfortable making investments again, and we start to get onto the backside of the pandemic. And with that, I will wrap it up and hand it back to our team here for the Q&A session.
Thank you so much, John. You're just a wealth of information. It sounds like you're actually a little bullish on Florida and how we're going to kind of set up and the pace of our recovery. Do you think we will outpace other markets, and how do you see that playing out this year?
Absolutely. I think Florida is going to be one of the strongest markets in the country, just based on the movement of workers to Florida. When we look at the movement of the jobs, when we look at the dynamics of the market, you look at the tax structures and the opportunities and the recovery prospects. Florida is at the top of the list, with Texas and North Carolina and Atlanta, Georgia. There's a lot of those markets, Phoenix, Arizona, that are attracting capital today. It's already happening, and it will accelerate in the second half of this year and going into 2022.
Yeah, one of the things I see as an office broker is there still tends to be a delta between the bid and the ask. So investors are looking for discounts, but we're not seeing a lot of markdowns in pricing, particularly in the office and industrial sector. What do you think in terms of, you said you don't expect a lot of distress, but in the office sector in particular, it's really hard for them to underwrite because we don't know how long it's going to take this adoption of remote working to actually work through the office system. So as big companies' leases roll, they are going to be reevaluating their footprint. So, some people think it's going to be a net neutral because of the de-densification. What are your thoughts about the office market in particular, and how long does it take us to kind of know what the new normal is for office absorption and the vacancy rates and pricing?
Yeah, the COVID discount that everybody's been waiting for really hasn't shown up. And the reason is that the buyers think they should get a discount. They see this, they perceive that there should be distress in the market and they want that discount. The sellers, on the other hand, have been very well financed. There's a lot of liquidity. There's a lot of financial strength behind these. They're not in distress. They may have some challenges, but it's manageable. And so the sellers don't have an incentive to do a heavy discount. They're willing to wait till they get to the other side of this and see what happens, because the expectation is that this is going to see a bit of a bounce in the recovery, and we see that leasing activity recover. The timing of that is going to be tied to hitting a critical mass of the vaccinations. Somewhere in the second half of this year, we start to see a recovery. 2022 is where we see much more momentum taking place. But there is a disconnect there between the buyers and the sellers. And specifically, when you look at South Florida, I think your thesis is much stronger than, say, New York or Boston, which have had a lot more challenges in their urban core, and the suburban space in Florida. I just in talking with our brokers, I know that they're getting a lot more activity on suburban office buildings today than they were over the last several years. It was really an urban centric model for the last 10 years. Now transitioning back into a suburban centric model that we saw actually in the 80s and early 90s. We're seeing a movement back to that over the course of the next few years.
So I want to encourage everybody that's on the call with us to go ahead and start sending your questions, and Jules will read them to us. She's our question asking Vanna. But in the meantime, Mark Bittner, so you had mentioned the moratorium and the forbearance for foreclosures, which of course has gotten extended with the new administration. So since everything follows residential, do you think that there is a plume of potential defaults that banks are going to have to digest that could create some drag even as we recover?
Well, I do think we're definitely going to see defaults go up because they've been held back. So there's some folks that simply aren't going to be able to work their way out of the hole they're in. But it's not going to be that large of a number. If you look at the number of homes that are in forbearance, mortgages that are in forbearance, it has really been coming down for the last 6 or 7 months. So the problem is actually not as bad as it was originally feared. And even when you look at apartment rents, and investment grade properties, the number of people that are not paying their rent in full is not nearly as large as was feared. And when you look at how much have made partial rents, it's almost, it's barely down at all. The real problem in rental properties has been in properties that are owned by individual investors or moms and pops that own duplexes and triplexes and quadplexes. And that's where a lot of the folks that entry-level folks in the leisure and hospitality are working. I am a little concerned about homes that were priced below the median, in that we haven't seen a whole lot of transactions in that market. That's where a lot of the problems have been. But just like in commercial properties, one of the reasons why commercial property prices have held up so well is there's just so much money out there. And so many of the people who own homes and own commercial properties say, I'm not so sure that this is just a short-term blip. why should I take a discounted price for this asset when the economy can be up and running again in another year, and I'll regret that decision. And so there's a real reluctance on the part of people to sell, and that's restraining supply.
So let's talk a little bit about policy and what we can expect in the next year in terms of economic policy. It may be a little easier to predict it now than it was in 2017 because there's a lot of known faces coming into the new administration. Chiefly, I was able to catch the confirmation hearings for Janet Yellen. So I just want to get your take, Mark, on Yellen and your thoughts about how she will address the economic crisis from a policy standpoint.
Well, Yellen is very adaptable, and I remember talking with her when she joined the Obama administration, and I had read a lot of her papers before she had joined, and she was kind of conflicting with some of the stuff that she had said in her previous work. And she goes, "Well, I have a different boss now," and so she is very flexible, and I think that there's no doubt where we are right now. The potential cost of overstimulating the economy is nowhere near as great as the potential cost of understimulating it. And so she's going to weigh in on the side of doing a bit more than we need. And from my perspective, where I see the risk is that we could have a short-term boom followed by a bust. And it has nothing to do with how we coordinate policy. It's that if we do overstimulate it, it's something that we haven't talked about, is that, how do you, when you throw trillions of dollars of stimulus, the real challenge for policymakers is going to be that year after we move past COVID and they try to take some of this stuff away. That's going to be the real challenge, to say that, it's like a drug addict going into rehab. I mean, it's going to be tough. It's got not that I really know that, but it's going to be tough.
Yeah, well, we got a $28 trillion deficit that we're a debt that we're actually looking at. So at some point in time, we got to pay the bills, right?
It's a hell of a habit that we've had.
Yeah. So I want to take a couple questions from the audience because we're running out of time. Jules, hit me with a question for one of our esteemed economists.
For Mark Bittner, the thoughts on the aviation space, specifically cargo airlines.
Okay, so Bittner, the thoughts on the aviation sector and specifically the cargo airlines. Miami, of course, is the largest cargo airport. So what are your thoughts about that industry?
Yeah, in terms of passenger traffic, the real problem on that side is going to be that it's going to take longer for developing countries to get over COVID than it does the U.S. Probably 6 months to a year longer. In terms of cargo, there are shortages of products everywhere, and so the supply chain is really out of whack. We've got this huge shortage of microchips right now, which go into everything, and that's slowing up production. So I would think that air cargo is one way that you can attack the supply bottlenecks that we've had, and I would think that the volume of air cargo is going to grow very rapidly. The other thing is that air cargo is goods, and the manufacturing sector in the United States is roaring. It had a number from the Philly Fed Index that came in 26 or something like that, very strong number this morning. Manufacturing is doing very, very well, and it really hasn't participated in this little pullback that we've seen the last few weeks. So I think that all segments of logistics are going to boom in 2021. I mean, it's just going to be a tremendous year for all of logistics.
So here's a question for John, and it's actually a very apt question. So we got all these companies migrating, right? So we're going to have companies that are coming out of denser areas. Does the lack of affordable housing in South Florida, does that actually create some constraint on our growth?
I don't think so. First of all, the definition of affordable housing, if you're moving from New York, everything's affordable in Florida, right? So if you look at the people who are moving down, it's not just low income people. You have high income people moving down, and that was one of the slides I showed earlier, was that Florida is attracting a lot more people with money. The housing, there is going to be more demand for housing. As I showed, apartment vacancy rates tend to be very low, especially with the workforce housing, and that is something that every state, every city is going to have to grapple with, will anticipate that that is not going to be the restraining factor. Yes, it will be under pressure. Yes, more housing will have to be built, but that's not what's going to slow down economic growth.
Good to hear. Okay, Jules says we got time for one last question. Jules, what's our last question? Who's it for?
This one is from Nick Wagoda. It's
Uh-huh.
With the stay-at-home economy being the thing past beyond early 2020 or 2022.
Oh, okay, I saw that one. Okay,
Yeah.
this is a John question, and Vintner can weigh in if you want, but essentially the stay-at-home economy, which of course we're all living in by necessity, is that actually going to be viable beyond 2022?
So
Is this here to stay?
Yeah, what we're seeing in studies is most employees, particularly younger employees, want to get back to the office. And that is going to be a driving force. That tied to company culture. It's tied to training, career development, experience, socialization. So I expect that there will be a movement back to the office, but it will not be as complete. So on the other side of the equation, a lot of people are saying, I want to work from home 1 or 2 days a week. That sounds great to me. So we will see some sort of adaptive model, people coming back into the office, part of the week staying at home, another part of the week. The big question in my mind is, how do you deal with that from an office space, right? So if somebody's coming into the office 3 days a week or 4 days a week, do they still need a cubicle or an office? Or are they going to share with somebody, or how is that actually going to work? So in terms of the office demand and the space absorption that's a result of that, we see it, kind of balancing out with where we've been over the last few years.
Okay, so my last question is always our crystal ball for our prognosticators here. So John, in 30 seconds or less, 2021, describe it for us. You got your crystal ball.
Yep, first half is going to be tough. Second half, we see a pretty strong pickup in the economy. We see a very strong pickup in investment into commercial real estate. We're going to see some early movers on the real estate side in the first half that are starting to feel comfortable with seeing the light at the end of the tunnel, but it will gather momentum over the course of the year. I've been watching the economic forecasts over the last 2 weeks have been getting higher and higher and higher. I think that there's a lot of optimism about where we're going to be by the end of the year.
Mark, your crystal ball forecast?
Fairly close to that. I think we start out slow, and January and February are probably likely to be fairly slow, but things pick up in March and April. And that unlike last year, we're not going to have a letdown in the summer. We're actually going to see things accelerate. And the numbers are probably going to be real strong. I don't think that any of the problems on inflation or interest rates, I don't think any of that's going to become a problem in 2021. So it looks like a very, very good year. And I think we're going to corral COVID sooner than people think. I mean, I think there's a lot of pessimism about COVID because of the mutations, but COVID itself is a mutation, and it looks like the vaccines are effective. I think that by the middle of the year that we're going to be getting out and about. I think there's a real question mark on tourism, though, because you don't just flip a switch on holding a meeting. You basically have some planning. So the convention business and business travel probably doesn't come back to 2022. But I've got a Florida vacation planned for June. So
Come on down. We'll have lunch outdoors.
I feel pretty confident it's going to be safe. We're going to be doing some fishing in the Everglades. So
I love it. Well, I want to thank both of our panelists. You guys were fantastic as always. This time next year, we're going to do it in person again, right? We're going to be back in 2022. Vintner's coming down, John's coming down. We're going to do it again. So before we say goodbye, I just want to let everybody know that we are going to be doing another NAIOP event. The Industrial Outlook event will be February 25th. We're going to do a little bit of a hybrid event. So check out the NAIOP South Florida website and look for our emails. Everybody have a great day. Stay safe out there.